So page 239 in the textbook, problem number 9. Ram, Robert and Rahim were partners sharing profits and losses equally. 3 partners are there, equal partnership. Their balance sheet as on 31/3/2013 was as follows. Cash at bank, asset side, cash at bank, debtors, less provision. Provision is for doubtful debts or bad and doubtful debts. Earlier we were taken as PDD, so that one only, PBD, the same thing. Stock, plant and machinery, building, and the last one is profit and loss account. The profit and loss account is a loss to be shared among the partners. Next, on the liabilities side, you have creditors, bills payable, outstanding expenses, reserve fund. Reserve fund to be divided among partners. Then capitals of Ram, Robert and Rahim is given. Next paragraph, Robert retired from the business and the following adjustments are to be made. First one, appreciate buildings by 10% and depreciate plant and machinery by 15%. Next one, second one, stock is valued at 15,000. Next, provision for bad debts to be increased to 2,500 on debtors. Underline the word to. So difference we have to take. Already some provision is already therein. So this is the value should be shown in the balance sheet as provision. Next, outstanding expenses valued at 2250 is a revaluation value. We have to check it is more or less. Fifth one, goodwill of the firm is valued at 1,26,000. You should underline the word firm. Firm is means all the 3 partners together. Robert's share of goodwill created and written off without opening the goodwill account. So what we are doing as per AS 26. Last one, Robert is to be paid 10,000 rupees and the balance transferred to his loan account. So first payment of cash, then whatever the balance comes, that should be transferred to loan account. Prepare revaluation account, capital accounts of partners, and the opening balance sheet. Opening balance sheet is nothing but new balance sheet. So this is the problem given. So I'll go for this page 239, textbook problem number 9, 12 marks problem. So I'll go for first 4 adjustments which are connected to revaluation. So I'll go one by one. First one has 2 parts, one appreciation, one depreciation. First, I'll go for appreciation. Appreciate buildings by 10%. So on the credit side of revaluation account, by buildings account, we have to see the building value, 50,000 in the balance sheet, 10% increase. So 5,000 increase. Next, depreciate plant and machinery by 15%. So decrease in the value of asset on the debit side. 2, plant and machinery account. $25,000 into 15%.
$3,750.
3,750. Plant and machinery by 15%, 25,000. Yeah, perfect. Good. Next, second one, stock valued at 15,000. The new value is 15. Balance sheet value, old one is 18. So from 18,000, it is reduced to 15,000. So reduction or decrease in asset to stock account, 18,000 minus 15,000. So loss of 3,000. Next, provision for bad debts to be increased to 2,500 on debtors. That means increased to this much in the balance sheet. So we have to underline the word to. By means we have to add the same amount. To means we have to take the difference between the new and the old. New one is 2,500. Old one is 1,000 rupees. So we are creating to provision for bad debts account minus old one. So 1,500 is created newly. Next, outstanding expenses valued at 2,250. Already we have in the balance sheet 2,500 as outstanding expenses. So from 2,500, it has reduced to 2,250, the new value. So reduction in liability is a gain. So we have to take it under liabilities side to outstanding expenses account, 2,500 old minus 2,250 new, 250 gain, reduction in liability. So first 4 adjustments we have done. Fifth one and sixth one will come in the capital accounts. So we can go for balancing this revaluation account. So which side is more, we have to check. If you look at in general, we find credit is less, debit is more here. Debit is more.
8,250.
Okay, good. 8,250. So I will take 8,250 on the credit side also. Then I have to find the difference between 8,250 and 5,250. That comes to
3,000.
Yeah, very good. 3,000. That 3,000 to be divided among the partners by partners capital account. The first partner is Ram, rupees 3,000 into 1/3 equal partnership. Remember, if you want, you can check once again.
2,750.
Yeah,
1,000.
profit and loss equally. You can see in the first line of the problem, equally. So 1,000 rupees for both the partners. So I will change the names: Ram, Robert, Rahim. So this is balance amount. This is called revaluation loss because loss side is more. As you can see, loss size is more, and gain side is less. So it is a loss for the partners. This is connected to revaluation account. Next, we'll move on to goodwill adjustment. Adjustment 5. Goodwill of the firm is valued at 1,26,000. Robert's share of goodwill is created and written off immediately in a way without opening the goodwill account. That's what we are going to do. So first we have to see given goodwill of the firm is valued at rupees 1,26,000. 1,26,000. Yeah, 1,26,000. So retiring partner's share of goodwill. Retiring partner is Robert. Robert is a second person.
30,000.
1,26,000 into 1/3. So 1,26,000 to be divided by 3. 42,000 it is coming.
Yes.
42,000.
Yes, sir.
Yeah, to be divided among continuing partners or remaining partners, Ram and Rahim. In their gain ratio, nothing is given. So 1:1, that is equal to 2. So 42,000 to be divided among the continuing partners. In their gain ratio, nothing is given. Equally means only 2 partners. So 1:1 only. So journal entry will go like this. Ram's capital account data. 42,000 into 1/2. 21,000.
21,000.
Rahim's capital account. Again 42,000 into 1/2. That also will be 21,000 itself, because equal partnership. 2. Robert's capital account. So being goodwill value to the extent of Robert's share and written off immediately. So whatever given in the problem, we have done as per that. That comes to accounting standard 26 itself. Coming to the combined partners capital account, I have a format ready. Ram, Robert and Rahim. First, we'll take the capitals from liabilities side. Capitals of Ram, Robert and Rahim, 40,000, 30,000 and 20,000. So liability shows credit balance. So by opening balance brought down. By opening balance brought down will be the capitals. Second one is looking for reserve fund or general reserve. We have a reserve fund of 24,000 here. So reserve fund of 24,000 in the ratio 1:1.
8,000 each.
Yeah, very good. So 8,000 each. So reserve fund account 8,000 each. Next, looking for profit and loss account. Profit and loss on the liabilities side, from asset side, not on the liabilities side. So it has to be taken to the opposite side. So to profit and loss account, loss rupees 12,000 in 1:1.
4,000 each.
Good. So 4,000 each. So these are the steps you have to remember for admission, retirement, or dissolution. The first few steps are common, no change at all. As you are seeing now. So after first, second, and third step, revaluation, profit or loss, we have a loss here, 1,000 each on the credit side. So it comes to the opposite side, debit side. So I will take it to the opposite side. It is debit side. So to revaluation account, it is a loss for each partner, 1,000. So these are the common steps always we do in a regular method. In regular method. So we have to remember these steps and we have to go on. The next one is the goodwill. Goodwill of the firm 1,26,000 and Robert's share. Already we have done that over here. Ram's capital 21, Rahim's capital 21 to Robert's capital account 42. So first we'll go for the value for Robert. So Robert will get from Ram 21,000. Robert will get from Rahim 21,000. So Robert is gaining here because he is giving a profit. The same has to be debited here to Robert's capital account. Ram has to give 21,000 and Rahim is supposed to give 21,000. So goodwill entry will be on two sides. So you have to be very carefully doing it. That is very, very important for you to understand. The next one is lost adjustment. Here, Robert to be paid 10,000 and balance transferred to his loan account. So first we have to close the retiring partner's capital account always. So it comes to credit is more 80,000, 38, 80,000. Yeah, proper. So credit is 80,000. I'll take that to the debit side, 80,000. So out of 80,000, remember the adjustment given, Robert is to be paid 10,000 rupees first. So we have to see, do we have a cash in the business? So we have cash at bank 22,500. Out of 22,500, 10,000 will go to Robert now. The remaining will be continuing in the business. So to bank account, cash paid. So here cash is paid to whom? You have to remember that is for Robert, 10,000 is paid. And they have told very clearly, and the balance amount transferred to his loan account. So we have to now find what is the balance there in the Robert's account. So 80,000 minus this 3. So 15,000 deduction,
65,000.
65,000 is the answer for that. So you have to be careful. This is the only new thing compared to admission, what you are going to find here, how the payment to be done. So part payment and part will go to loan account. So to Robert's loan account, remember balance amount is 65,000. So Robert's account is settled. Robert's account is closed. So Robert is no more a partner of the business. Now, after closing his account, we have to think about other two partners who are continuing in the business. What is their capitals? that is balances. So that we will take over here to the debit side, and now balance, that balance will become closing balance carried down to the new balance sheet. It will be carried. Check the balances is right or wrong. 48,000 minus 25, I got 23. 28,000 minus 26, so 2,000. So capital accounts are closed. Hope you understood the entries therein. Now we'll move on to
Sir,
ah,
sir,
yes.
there the closing balance for RAM is 22,000.
Okay, 22,000. Okay, good. 22,000 is the balance. Perfect. Yeah, fine, good. So now Robert's loan account. So what is the money that is to be transferred to loan? You can see here 65,000 that has to be credited to Robert's loan account, that comes from Robert's capital account. So loan amount is not paid here. Remember, cash is paid to the partner. If money is paid towards the loan, the cash entry or bank entry will come in loan account, not in the capital account. So you have to be careful. Here in this bank balance, we have paid 10,000 rupees to the retiring partner. If it is transferred to loan, then it is paid, it will come here in the debit side. Here it is going to come as to bank account. You have to be very careful about that one. Next, the new balance sheet or revised balance sheet. So cash at bank, old balance 22,500. Out of that, 10,000 is paid to the retiring partner. It is going to be 12,500 is the closing balance. No need to prepare a cash account, not necessary. Then debtors 20,000. So less provision 1,000 old one plus 1,500 new one. The total is 2,800. So you have to remember this. Very important. Next, stock 18,000. We have an adjustment, remember. The new value is 15,000. So decrease 3,000. New value 15,000. You can see here, stock is valued at 15,000. Next, plant and machinery 25,000. Less you have a depreciation of 15%. At 15%, you can see here in the revaluation 3750. I'll take that here. So outer column 21,250. After plant and machinery, you have building. Building is appreciated. So inner column, because there is an adjustment, appreciation of 10%. So 55,000. P&L account we have divided among partners. Coming to the liability side, creditors, bills payable remains same. Creditors 21,000. Bills payable 9,000 remains same. The next one is outstanding expenses. We have an adjustment. $2,500 was there. Now it has decreased by 250. So new value is 2250. You can see here, outstanding expense valued at 2250. So that is a new value. Decrease. Next is reserve fund divided among partners. Next we have to take capitals. Before capitals, we go for
Loan.
Robert's loan account. Remember, always first take the loan. You should not forget. Robert's loan account is 65,000. Then capitals of the remaining two partners, Ram and Rahim. Ram's capital is 22,000. Rahim's capital is 2,000. So we have to check revaluation account always before closing. Plant and machinery taken, stock is taken, provision for bad debts taken, buildings done with the adjustment, outstanding expenses is taken. So we can go for totaling without any hesitation.
Twenty-one
1,21,250.
250.
Check on both the sides. Yeah, it is the same on both the sides.
Yes, sir.